What is a management accountant? One of the best ways to look at who is a management accountant or what is a management accountant is to examine the CGMA competency framework. So CGMA is the Chartered Global Management Accountants. In that, they outline 4 types of skills that a management accountant should have. First, technical skills to apply accounting and finance skills. Second, business skills to apply those skills in the context of the business or the enterprise. Third, people skills to influence people with information in hand. Fourth, leadership skills to lead within the enterprise. So these are the 4 broad skill set that is propagated by the CGMA as required competencies in their syllabus. If you look at the global management accounting principles of the CGMA that benchmark the finance function for enterprise value creation, there are 4 aspects in it. First is communication that provides insight, that is influential. Second is to have or collect information that is relevant. Third is to analyze the impact on value of that information. And fourth is to build trust on the stewardship that is received from the enterprise within the organization, within the enterprise, and with business partners. So management accountants' typical responsibilities are on reporting, strategies, risk management, taxation, and investor relations. The principles for value creation through the accounting activity is enacted through 4 aspects, which is outlined on the CGMA principles, is to communicate. Now, communication means it's also ability to listen and ability to converse clearly and write clear and coherent reports. The second is analysis. That is to analyze and demonstrate cause and effect relationships with the technical methodologies that are in place. Third is to use those, that's the analysis and communication skills, to transform them into information that is useful for reporting for external users and internal users. And the fourth is the managers with different responsibilities would often require the information in an accounting system to be processed or reported in different ways. So you provide the relevant information to respective decision-making centers or people so that they can focus on the relevant information and make sound decisions. The CGMA credentials with the CIMA UK qualification must follow 5 fundamental principles. First, integrity. The second, objectivity in conducting work. Third, professional competence and due care. Fourth, confidentiality of information. And fifth is professional behavior. When management accountants create enterprise value, they have to keep in mind 3 aspects. First is the benefit cost analysis. That is, whether it is short term or whether it is long term. Return on investment, payback period. They have different implications. Second is the behavioral and technical considerations. The behavioral and technical considerations would influence staff behavioral changes required to accomplish enterprise goals. The third is to appropriately cost for different purposes, to follow appropriate costings for different purposes. The short-term decisions could be costed as variable and fixed costs, and long-term decisions could be costed as using activity-based costing with cause and effect. One of the confusions and misconception is cost accounting and management accounting. Cost accounting is only a subset of management accounting, financial accounting, and activity accounting. It does help all 3 facets, but is not in totality of any of those paradigms. There are differences between management accounting and financial accounting. They can be classified into 4 themes. The purpose of information. Management accounting make decisions about enterprise goals, whereas financial accounting use the information to report about performance to stakeholders. Second, information uses. Management accounting primarily caters to internal users, and financial accounting primarily caters to external users. The measurement rules of information. In management accounting, it's contextual, it's purpose-driven, and has a time horizon influencing on it. Whereas in financial accounting, it's compliance-driven. The fourth is the breadth and the depth of reporting. In management accounting, it's contingent upon the user, whereas in financial accounting, there are standards to comply, and the breadth and the depth is defined by the compliance requirements. The fifth are the behavioral implications. In management accounting, the financial and non-financial events are reported. Even non-financial events are not so directly measurable. But in financial accounting, because of the compliance requirements, Primarily, the measurable events are reported. So this brings us to the end of the video, and thanks for watching. I'm Professor Indra Besekra. When we want to look at the role of management accounting, it's good to look at a case example. I've taken Sundrop Farms, and it made these statements. If you are a traditional farmer, you will need water and energy to grow your produce, and you will need lots of it. The challenge is that there are finite resources that are becoming even scarcer. Our solution: not to use them. We don't extract groundwater from the planet at unsustainable rates. We don't rely on fossil fuels, and we don't use soil or valuable farmlands. Instead, we have developed technologies that integrate solar power, electricity generation, freshwater production, and hydroponics. It produces an equivalent quantity of food to that grown using traditional methods, but the quality is significantly better. So if we touch base on the history of Sundrop Farms, which is located in Port Augusta, South Australia, commenced their operation as a pilot project in 2010 under Seawater Greenhouse Australia Private Limited. In 2016, significant technology changes led to the Sundrop system that led with dissolving the joint venture with Seawater Greenhouse Australia Pty Limited, and on the same we expanded the operations to 20 hectares in Port Augusta and opened operations in Portugal and United States. So what's notable about Sundrop Farms is that it uses salt water for irrigation by desalinating them, and solar energy to power and cool the greenhouses. So the seawater that's been desalinated, and initially that salt was concentrated to produce salt, granular salt, but later the farms came to an agreement to release the concentrated salt water by diluting with seawater to an acceptable level to channel back to the sea. So it uses the fresh water for irrigation, and then the solar system provides the heat and uses the power and cooling for the greenhouse. The farm produces truss tomatoes. So Sundrop Farms entered into an exclusive agreement with Coles to sell their products, truss tomatoes. The farm made an investment of 180 million to 200 million on exhausted farmland with little potential for traditional agriculture. So there are several business partners of Sunroof Farms, Coles as customer, UC Davis and University of Arizona as research and development partners, Government of South Australia as a funder, Macquarie Bank and KKR as equity partners, and then eSolar as a solar system provider. So all these business partners are part of the value creation at Sunroof Farms. So how can management accounting help enterprises like this? There are 5 aspects to note. First is the innovation, whether it's an incremental or disruptive innovation or radically different. Second is the enterprise model used with the different products, processes, and systems. Third are the opportunities that's available with the products, markets, financing, and political situation. And the fourth are the risks associated with those opportunities of products, markets, financing, and the political situation. And finally, fifth is the value creation that is enacted to the opportunities, realizing the opportunities and managing risk. So in relation to Sunroof Farms, it was a radically different or disruptive idea of having a greenhouse in a land that is not able to cultivate, and coming up with an enterprise model which is environmentally friendly to produce trash tomatoes. The opportunity that was available for the Sunroof Farm was year-round production of tomatoes and having a contract, a ready contract with Coles for the sale of tomatoes, and expanding the markets from Australia to Portugal and US, and convincing the venture capitalists to invest in the venture, and having the political backing from the government of South Australia. Along with that came the risk minimization, having a steady contract for the marketplace to sell tomatoes, convincing the venture capitalists with a steady cash flows, and the political backing of the government of South Australia for the project. That assisted the value creation in the Sunroof Farm. Another way to look at is take the global management accounting principles framework and look at the 4 aspects, that 4 principles embedded in it. Is a communication that is insightful and influential, gathering information, relevant information, and sharing them, and examining the impact on value and building trust. So in relation to the Sunrock Farms, it used the decision relevant financial and non-financial information to generate and preserve value for the farm. And in relation to the global management accounting principles, it communicated its performance to the business partners, collected and shared relevant information, and build trust with the business partners and analyze the impact on enterprise value to consolidate the relationship with the business partners. This brings us to the end of the video, and thanks for watching. What's supply chain and what's value chain? Supply chain starts with material planning, then material procurement, then it's going to the warehouse, and from the warehouse to the production. Then the product is being distributed to the customer, and any repairs and returns are being taken care of to satisfy the customer. So it's from material planning to customer satisfaction. Porter's value chain is a model to analyze the supply chain, in that Porter identifies primary activities and support activities in the supply chain. So there are 5 components of primary activities: inbound logistics, that is something like material procurement, operations such as production, then outbound logistics such as distribution, then marketing and sales, and then service such as repairs and returns. The chain is supported by support activities such as procurement, technology development, firm infrastructure, and human resource management. So efficient management and deployment of supply chain is to ensure increasing profits. So there's difference between supply chain and value chain. Supply chain interconnects all the functions starting from manufacturing of raw material to finished products, and it reaching the final customer and satisfying the customer. Value chain, on the other hand, is a set of activities that focuses on creating or adding value to the product. Both networks help to provide quality products to the customer at reasonable price. Most of the time, supply chain is connected with the value chain. So when we compare and contrast the supply chain with the value chain, supply chain integrates activities from production to sale. Value chain is about adding value to the product. Attention on the supply chain is at the operational level. Attention of value chain is at the strategic level. The concept behind the supply chain is conveying the product to the customer, and on the value chain is adding value to the product. The sequence on the supply chain is from the raw material products to the requested sale and satisfying the customer. So it's a forward chain, whereas the value chain is about inquiring into the customer requests and then going back to the product to meet those customer needs. So it's a backward chain. Outcome on the supply chain is customer satisfaction, and on the value chain is about gaining competitive advantage. For example, value chain is finding out about how to add value to the customer in different ways. A very generic type of example for that is someone going and buying a brand new pair of shoes, and the salesperson would then also offer a shoe cream along with the brand new pair of shoes, whereas by doing that, it is increasing the value to the enterprise through selling two items, two products, and also increasing the value proposition to the customer, so that the customer gets enhanced satisfaction and meeting customers' demand. This brings us to the end of the video, and thanks for watching. Planning, control, and decision making. These are three aspects of management accounting. Let's look at planning. The planning starts with statement of values. There are three statements of values. The first one is the vision statement. That talks about the long-term goals. The vision statement is a very broad statement. The reason for stating it so broad is that with time, that the objectives can change because the environment, enterprise's environment can change. When enterprise's environment changes, the goals that are set should be able to accommodate those changing objectives that arise and transform with the times. The second two statements are the mission statement that talks about the purpose of the enterprise and the scope of that enterprise. The third statement is the morality of the enterprise. So these statement of values set the humanness or bring the humanness to the enterprise. Once the statement of values are articulated based on the long-term goals, planning for goals accomplishment can be enacted. There are two planning aspects. One is the long-term planning which is called the strategic planning, and the second is the short-term planning, which is called the budgeting or budgeting planning. If you look at, for illustration, the statements of Boral Limited, which I obtained from the Boral's website. The vision statement is about delivering world-class safety performance and delivering less resource and energy-intensive products for our customers are central to our vision of delivering performance, excellence, and sustainable growth. Mission statement: at Boral, we recognize that sustainability is fundamental to our future success and our ability to build something great. Value statement: this means providing a safe, diverse, and rewarding workplace for our people, minimizing our environmental impacts, and taking a socially responsible approach to how we operate. So, by looking at these three statements of values, we can acknowledge that Boral has a focus on sustainability and environmental protection. That brings the humanness of the story of the enterprise, and this humanness of the story of the enterprise resonates with the human beings who are supportive of sustainability, and those people who are supportive of sustainability and with the Boral's support for safe and diverse, rewarding workplace for such people is attraction for such people to work for Boral. It becomes a delight because the humanness that's been enacted through the value statements resonates with the actual values of the people. The second aspect is about the performance and providing feedback on performance. The performance is evaluated based on the plan set, the strategic plan, and the budgeting plan, that is the long-term plan and the short-term plan. And these plans will be identified with objectives, or the objectives would be designated as indicators. Some enterprises, due to numerous objectives, would identify key objectives which are designated as indicators, which are called key performance indicators, and would want to focus on those key performance indicators set for the staff members. The feedback on performance is performed based on the plan objectives and or the indicators that are set, and then comparing with the performance, actual performance of those objectives and or indicators. Such differences would be then analyzed and then informed to the staff members to enact any behavioral changes, to support any behavioral changes so that the enterprise goals could be accomplished. The third aspect is the decision making. There are two areas of decision making. the strategic decision making, which are done by senior management and the board of directors. They're about long-term decisions which sets the direction of the enterprise. Then the other aspect is the operational decisions. These are made by the middle and junior managers, which are about short-term decisions, and they relate to the management. The decision paradigms for strategic comes from the strategic plan, and the decision paradigm for operational comes from the budgeting plan. These decision making can work both forward as forward looking and backward looking to implement the plan. And then once the plan is implemented, those decisions made can be useful in providing a feedback to the respective staff members or the senior management and directors. This brings us to the end of the video. Thanks for watching. I am Professor Indra Besekara.